Okay, so I think we've got most people in now. So yes, as Aoife says, welcome everybody to our second all Preqin Acts webinar. Um, Again, looking at kind of the impact of COVID-19 specifically on the alternatives industry in APAC. Our first session last month was a great success, and I have every reason to know that this one will be too. Um, it is being run by your ACT groups. I'm sure most of you by now know who the ACTs are, but they are our industry experts drawn from across Preqin. They take time to read news, go out and talk to clients, analyze the data, and generally make it their business to know all that there is to know about what's going on in the various asset classes. And then they use that knowledge to help consult on our content, present at conferences, speak to the press, and indeed host internal webinars for all of our benefit. Yeah, the structure for today is that Aoife will kick us off in a second with an intro for the region and the industry as a whole and how the pandemic has affected it. And then the different groups will cover trends in individual asset classes, and then we'll finish with a Q&A that Mark is very kindly kind of comparing for us. If you do have a question, you can ask it anonymously using the Q&A function at the bottom of your screen. So please do, please do let us know if there's something that you would like the acts to cover, or if you have a question about anything that they've talked about. So without further ado, I will hand it over to Aoife to kick us off.
Thanks very much, Will. It's good to get everybody on this call. It's our second ACT webinar, but it's our first with an APAC focus. So we're really pleased to be given this opportunity to be sharing our observations on this part of the world. If we could move on to the next slide, I'll introduce our speakers. As you can see, I don't look like that anymore. Put on some weight during COVID-19. And when we set up our Asia presence, about 10 years ago now, it was just 5 of us working out of a service office here in Singapore. But today we are a team of more than 70 spread across Singapore, Hong Kong, Tokyo, and Sydney. And we are supported by more than 150 people in Manila, India, and Guangzhou. So drawing from this pool of talent and experience, I'm very pleased to introduce our speakers today. Judith has deep knowledge on Southeast Asia, one of the fastest growing regions in Asia, and she will be sharing our analysis on private equity. Kai, who joined us this year from Accuris, is a senior writer on our content team, and he will give his perspective on real estate. Diana, our resident research expert on all things to do with hedge funds in APAC, will be talking about an asset class that she's uber familiar with. Nicole, our head of content, brings a global perspective to our discussion on real assets. And Jiexing, who has expert knowledge of Greater China, will share with us her thoughts on an asset class that's seen a rise in interest, and that's a pun that's absolutely intended in recent years, and that's private credit. And of course, we have the pleasure of Mark to moderate our Q&A. The presentations will take about half an hour, after which we will enter the Q&A sessions. Like Will mentioned, please feel free to send in your questions via the Q&A function, and we will do our best to address them later. Before we go into our first speaker, let me bring you on a virtual tour of Asia in our next slide. One thing to bear in mind is that Asia is not a homogeneous market, but it's a collection of countries with different languages, cultures, food, and a pace of growth. So here I have a very simple rating for how well each country is doing in terms of pandemic control, as well as the state of their economy. The more smiley faces, with 5 being the best score, the stronger the infection control, and the same with the stars. So if we start clockwise from the top left, China was really the first to enter into lockdown, and their model of locking down a country or a city has set a template for the rest of the world, and they were also the first to re-emerge. China has not reported many new cases since late April, apart from a few isolated clusters that's emerged in the northeastern region recently, and that's why I've given them 4 smiley faces instead of 5. Key financial centers like Shanghai and Beijing are in the clear, and industries have restarted in March. Domestic spending lags the reopening of the economy though, as you will hear from Kai later, and global trade orders have also fallen. China makes up half of the alternatives industry in APAC and also the largest slice of our revenue in Asia. So it is important for us that China remains strong and healthy. India, with slightly more people than China, but half the income per capita, is in a precarious position. Infections have not peaked, it's still going up every single day. It's difficult to control because living conditions are tough for most of the population, and it is in fresh lockdowns until the end of this month, tentatively. So it is also dealing with lingering effects of the non-bank financial corporation credit crisis that started in 2018. The economy is expected to shrink 5% this year compared to a growth of 4% last year. And because of this, EY has predicted that PE and VC deals are going to undergo a decline of 60% this year. If we Google Vietnam and COVID, we will see a lot of headlines saying success story, under control. And indeed, Vietnam has not seen new cases for most of April and May. On the sporadic days that they did, these were mostly in the low single digits, and Vietnam has had no death from the illness. And these numbers have been verified by international experts. So a combination of an early lockdown, quick contact tracing, as well as aggressive testing has led to their success. The bickering between US and China has led to a positive spillover effects for Vietnam, as it has firmly established itself as a credible manufacturing alternative to China. VC deals and property prices have been on the rise in Vietnam, and its early pandemic success and the continued friction between the US and China will mean that it is going to be one of the brightest stars in Asia. Going on to the land of the crazy rich Asians, we are about a month past our infection peak. Singapore has just emerged from a 2-month lockdown, and a gaggle of F&B, retail, car rental, oil and gas businesses have folded. Even now, we are slow in reversing our lockdown measures, and that's great for public health, but really depressing for our economy. This lockdown has resulted in a low volume of real estate transactions, but fortunately, the pricing has remained stable. Our GDP growth is expected to be -7% this year, and I would have given Singapore another star if not for the fact that the COVID budget that the Singapore government is spending is about 20% of our GDP, which means that the real contraction is actually -27%. Australia has emerged from a lockdown. They had their peak in March, and a McKinsey survey showed that Aussies are half as optimistic about their economic recovery than those in the US. And in part, this is due to the highest unemployment rate that they have seen since 2015. Australia is very heavily dependent on commodities exports to China, as well as agricultural and food products globally. And because of this intrinsic link, it is a muted outlook for Australia, especially in riskier assets. LPs in Australia with a traditional preference for stable yields are likelier to be even more hungry for income producing assets for the rest of 2020. Hong Kong, which holds the distinction as one of the only 2 places in Asia never to have undergone a lockdown, the other being Korea. It has seen really positive pandemic control success. Businesses carry on, meetings are still conducted, albeit in smaller groups, but social unrest has weighed heavily on the economy. A year-long protest has resulted in falling home, office, hospitality, and retail property transaction volume and prices. And there are some reports of high net worth individuals moving their wealth to other locations. In Korea, they managed to flatten the curve without a severe lockdown, and they've pioneered the practice of drive-through testing. But a few clusters have emerged recently from a night spot, and that may tarnish their record. In general, Korea's economy has been resilient. Transactions have continued to happen in Q1 of this year. In fact, commercial property transaction volume increased in Q1 compared to Q4. And banks continue to lend. Investment banks continue to underwrite deals, and there is that increased liquidity in the local market as domestic LPs turn their attention from overseas markets to Korean deals. Last but not least, Japan has largely regained control of the infection. They lifted their state of emergency about 2 weeks ago. It is the world's third largest economy. They've entered into a technical recession in Q1 and expecting further shrinkage in Q2. It is an export-driven economy, heavily affected by a slowdown in global trade flows. Nonetheless, KKR last year declared Japan as its highest priority market outside of the US. And Carlyle recently rejigged their senior management team in Japan, while a local buyout firm, Advantage Partners, has just closed an $800 million fund in April. So businesses with good fundamentals facing a short-term volatility from the virus, non-core arms of conglomerates, and local brands facing succession issues should continue to see strong interest from these buyout groups. If we can move on to the next slide, here are some measures that governments across APAC are deploying to support their economies and the alternative sector. There are just a few that we have highlighted here because they have a direct impact. AMAC, and we can think of them like the SEC of China, is a regulator we have direct access to, and it's all credit to Hui Min and our Hong Kong team for starting and maintaining this relationship. We've gotten insights into AMAC's operations, and one positive change that they told us has come up is that the requirement for GPs to secure an anchor LP within 6 months of a fund launch has now been extended to a year. And we know that AMAC is also looking at the secondary space with interest because of a boom in fundraising in the last few years. So we are in talks with them to share with AMAC our data and insights on the secondaries market globally. A positive development for foreign GPs and banks is the elimination of the ceiling on how much of a stake they can take in joint ventures. It was previously 49%, but with the lifting, all fund management firms and investment banks can be wholly foreign owned. Hong Kong has introduced a new fund structure called the LP fund, and that's to encourage more local domiciling of funds instead of turning to BVI or Cayman structures. Singapore has done the same. We have introduced a new structure called the VCC, and just 2 months ago, our central bank, MAS, launched a $125 million grant to support financial institutions and fintech firms by supporting the workforce training and manpower costs, digitalization efforts, and a streamlined process for financial institutions to gain a first-level assurance about the quality of fintech solutions. Last but not least, India has an interesting revision to its FDI policy, and the background of implementing this revision is to protect local companies from being scooped up opportunistically by foreign capital during this COVID-19 pandemic period. With that whirlwind tour of APAC, I will now hand the time over to Judith to talk us through her observations on PE.
Thank you, Ifai. Yeah, just before I kickstart, I just wanted to give credits also to Ruben, who's part of APAC think tank team in PE, who has contributed a lot in putting all these insights together from the Greater China research side. So yeah, it has been about 5 months since the outbreak started. And so in the next few slides, we will review the impact on APAC PE in terms of fundraising and deals. So in the recent global survey that Helen ran on the impact of COVID, we know that 55% of the fund managers globally reported a slowdown in fundraising activity. So what are we seeing in terms of APAC fundraising? Just on the left-hand side, you can see that we reviewed the number of APAC-focused PE funds closed on a monthly basis since the beginning of this year. So what we noticed is on the month that World Health Organization declared the outbreak of pandemic in March, the number of funds closed increased and in fact doubled from the previous month. We expect this period to be a challenging time for most firms fundraising. So we also look at the target size. And what our data revealed is that 30% of the funds closed in March were closed at 17% less than what they initially set out to raise. So considering the slower pace of fundraising in this market condition, coupled with a few factors like LP, they are unable to do due diligence or on-site visits. What our data shows is that fund managers chose to close the funds at less than target size and to start putting the money to work rather than prolonging the fundraising period. Is this all gloom and doom in the fundraising for APAC this year? Not quite yet, because we found a silver lining in PE secondaries. So just last year, 9 APAC-focused secondary funds were raised at aggregate capital of 2 billion. And in just 5 months in 2020 this year, the same number of funds are on the road, and aggregate capital already exceeded what was raised last year by almost $500 million. So what we think is that as private equity matures in APAC, building a larger base for the primary funds over the last 10 years, PE secondaries has become an alternative strategy for exits, especially during this COVID crisis period, for those who are concerned about denominator effect, liquidity, or cash flow issues. Yeah, so moving on from fundraising, on the next slide, we look at the impact on transactions. The breakout first started in China, and China has since moved out of lockdown state. So to check the market sentiments and whether we are on road to recovery, we thought it would make sense to study the transaction volume in China. So comparing the VC deal volume in the same period last year, Jan-Feb, the deal volume has decreased by 57% in the first 2 months when the outbreak first hit this year. However, if we increase the time period and look at deals done between Jan through to April, the deal volume is just 40% lower as compared to last year. So what we are seeing is that the gap is narrowing and there is a pickup in deal transaction in the recent months. And let's just say there's no surprise on second wave of widespread in China. We expect the deal volume to slowly pick up momentum through the rest of this year. So in the next slide, there's also, given that our deals data is updated daily, it gives us visibility to study the trend on a week-by-week basis, which is suitable for this constant changing virus situation. So on the week that Wuhan lockdown was announced, we noticed that the deal volume fell to a single-digit transaction. However, it's now recovering to regain back to the volume transacted in December prior to the outbreak announcement. As China and India are the top 2 countries with the highest number of reported cases, and both countries implemented lockdown, we also look at the VC deal transaction for China and noted almost similar trend as China, where deal volume dipped in the wake of the lockdown. So are we expecting smooth recovery of transactions post-lockdown period? We believe so, because based on the feedback that when we speak to the fund managers and what we're hearing on the ground, the recovery of the deal transaction can be also attributed to the fund managers looking closely at the recycled deals. And these recycled deals are the deals that fund managers had previously conducted due diligence on, but did not invest in them. Because due to the current situation where fund managers are unable to perform due diligence on new deals, and that there are some sectors that are now more attractive than when they first evaluate the deal, the fund managers are now looking at these recycled deals more closely and investing in them now. So in summary, we do see things picking up slowly as virus situation in APAC gets more and more controlled. Thank you. And I'll pass on to the next speaker.
which is Kai, who's going to talk to us about real estate.
Yeah, thanks, Judith. All right, so as we know, COVID-19 started circulating here in Asia before other parts of the world. So this has given us some opportunity to collect more data on the impact of the pandemic so far in the private real estate space. So looking at fundraising in APAC, it was off to a pretty rough start, as you can see from the chart. Q1 fundraising saw only 7 funds close, securing 1.6 billion. Now, to put this in perspective, our data shows it's actually the slowest Q1 for APAC in the last 10 years. We tend to see in any given quarter the number of funds closed in the mid-teens, and over the last 5 years, the average amount of capital raised sitting around 3.9 billion. So COVID-19 has definitely had a significant impact on fundraising. You know, fund managers haven't been able to travel, they haven't been able to see their LPs, so it hasn't been easy. Now, that said, there is reason to be hopeful. So, zooming out to look at the year on a half-year basis, so Q1 plus Q2 so far, fundraising levels are comparable to the first half of 2015 and the first half of 2016. This is mainly due to the significant pickup in capital secured by funds in the second quarter. So aggregate capital raised more than doubled to 3.6 billion, in line with our quarterly averages. But the number of funds is still low. 5 funds only closed, showing concentration in only a handful of GPs. But I think more interestingly, around 75% of capital committed was soaked up by one fund manager in Q2. PAG raised 2.7 billion for an Asia-focused opportunistic RE vehicle. So opportunistic and value-added strategies like this have accounted for most of the capital raised over the years. This seems to be continuing as the need for upgrading residential, commercial, and industrial real estate grows with Asia's economic and demographic demands. Now, going forward, these regionally focused strategies may also be well positioned to hunt for attractive assets, with economic recovery looking a little more U-shaped, leaving potential for emerging turnaround opportunities over time. Next slide, Will, please. So now looking at deal making, we actually came off a really strong 2019 for deals, which saw the second highest deal activity on record after slumping in 2018 during the US-China trade war. The start of 2020 was slow. Q1 posted only 56 deals at 6.9 billion in aggregate deal value. The second quarter so far has been even slower, so things seem pretty grim. But we thought, digging into the numbers a little bit, it might be actually interesting to show the kinds of deals that actually are happening right now by looking at the largest deals over the previous 3 months, so March to May, right when the initial shock of the coronavirus passed and talks of reopening started happening. We hear a lot about office being very negatively impacted by the new normal of working from home, but actually the 3 largest deals and the largest one were actually single asset office towers. So now this space is still valuable for GPs. The design and operational mix of these properties may change, but GPs are still seeing value in these assets. A couple of GPs did mention that South Korea, Taiwan, and Japan have been fairly resilient in terms of asset values and deals. And interestingly, you can see from one of the top 5 deals that South Korea is there, and one of the largest deals, or the largest deal for the year, actually happened in Japan in February for a residential portfolio between Blackstone and Anbang Insurance. So then what's next? Will, next slide, please. So I wanted to show a chart, a graph that EFI used during our joint webinar with the Asia Pacific Real Estate Association. This is from our Preqin quarterly monitor. You can see that APAC has offered up increasingly strong performance since the GFC. Now, the question might be why? Well, to be frank, there's been and there still is a very big need for RE infrastructure in the region. APAC is one of the fastest growing regions globally. It's averaged more than 5% GDP growth over the last decade. Maybe most importantly, from a demographic standpoint, of the 2.4 billion new middle class members entering the global economy by 2030, 90% are expected to come from APAC. So to support all of this growth and to put a roof over the heads of a rapidly expanding affluent population, private capital real estate will need to serve as a backbone to fuel development. So it's not going anywhere. And that's kind of like the sense we've gotten from GPs and advisors. Now, these are some comments we've gotten, but as a final point, I wanted to just pull out one case study. EFI mentioned I was going to talk about it. A global GP with a pretty large portfolio of malls in China noted that with the lockdown ending, foot traffic in malls have returned to around 80% of their pre-COVID levels. but spending is still lagging significantly behind. So tenants aren't seeing that, recovery in cash flows as they previously thought they would. This is interesting because I think it highlights just because markets are opening doesn't really mean people are going to start spending right away. So, and it actually shows the reality of a U-shaped recovery. So thank you very much. And I think Diana is next.
She is indeed. Thanks, Kai. Diana, yeah, going to take us through what's happening in hedge funds.
Thanks, Will. So to provide you a little background on the Asian hedge fund industry before the COVID-19 situation, we have seen more and more European and American fund managers opening offices in the Asia Pacific, specifically in China. They see it as a good opportunity for the growth of the global economy and also for them to offer diversified investment options for their investors. But COVID-19 has affected hedge funds in APAC, just like how the global industry has been affected. I'll quickly run through how it has influenced performance, asset flows, launches and liquidations, as well as how managers and investors have reacted. As you can see on the graph, on the first quarter of 2020, APAC hedge fund AUM has dipped below the 100 billion mark. This is the first time since we started aggregating regional figures in 2015. We also saw a net outflow of $21.7 billion, 1.7 times higher than all of 2018's full year net outflow, which only amounts to $12.6 billion. Despite this, APAC still reported that 28% of funds have received new money this quarter, offsetting some redemptions. If hedge funds are able to effectively manage investor capital, then we should be able to see more inflows this year. In March, where the global market suffered the biggest downturn, a vast majority of APAC-based funds posted negative returns, as many hedge funds were caught up on the volatility. On a more granular level, China and Australia were more exposed on the long side and saw greater losses, while Japan, on the other hand, have positioned themselves defensively, resulting to minimal downside. As these settled down in April, performances have rallied, ending the month with a 5.34 return on average. Interestingly, despite the negative situation happening since the start of the year, no funds have liquidated in March and April. In fact, some significant launches have happened in the midst of crisis. Examples are Modular Asset Management and Diamond Asia Capital, who launched at $1 billion apiece, making them the top two biggest hedge fund launches in 2020. If you could go to the next slide, please. Thank you. As for investor reactions, conversations with APAC-based investors say that they are not looking to invest in both hedge funds and alternatives in the short term, although some LPs are taking advantage of the market downturn and are now actively sourcing. Family offices are also increasing exponentially in Asia, and COVID impact shows families are staying away from long positions in equities, in which they could turn to hedge funds as a defensive position and to generate uncorrelated returns. This is actually a good opportunity for hedge funds to prove their worth in providing downside protection to their investors. On the fund manager side, based on our conversations, APAC-based managers have adapted better and quickly on the pandemic compared to Europe and North America. Most of them said that there's very little to no impact on their portfolio, although those who have been impacted have now been very cautious. This could be attributed to the fact that this is not the first time Asia Pacific was hit by a pandemic. There was SARS in 2003 and MERS in 2012. Although in a smaller scale, these previous pandemics have made Asian nations more adaptable, and they were able to prepare business continuity plans compared to Europe and North America. Another thing is initially, COVID-19 has slowly spread in Asia compared to the rest of the world, which bought fund managers time to realign their investments and rebalance their portfolios. The current market condition provides a good opportunity for hedge funds to take advantage of macroeconomic events and generate alpha. Strategies such as macro, relative value, and CTAs are proven to perform amidst downturns. On to the third slide. Now let's move on as to how Preqin can be relevant during these times. Hedge funds is going to be in the spotlight due to its diverse range of strategies, and Preqin can come in handy to quickly ascertain which funds have prevailed during these times. Due to the market volatility and uncertainty, investors would want uncorrelated returns and alpha offered by hedge funds and are going to rely on our dataset for due diligences using our extensive and on-time data and performances. Fulfilling our promise to provide up-to-date information and relevant industry analysis, Preqin will be releasing its Asia-Pacific Hedge Fund League tables in August 2020, showcasing the best performers in Asia-Pacific in the first half of the year. Thank you, and on to the next speaker.
Thank you, Diana. Our next speaker is Nicole, who's going to take us through what's going on in real assets. So thank you, Nicole.
Thank you, Will. Thank you, everyone, for listening in. And thank you, Jordan, Charlie, and Charlotte Mellon for help with these charts, and to my ACT for all your feedback. Today, I'll be explaining why COVID-19 could weigh on solar deals in APAC and globally, and why this matters. I'll then talk about which APAC nations offer the best opportunities for investment, and how one country in particular, China, is transforming the solar industry across the globe. So let's dive in. First, if you look at this slide, you'll see that solar deal values are declining in APAC and globally. Why? Is this because appetite for renewables is decreasing? The answer is no. In fact, the cost of solar is falling by almost 3/4 thanks to the rise of new technologies. And that's why governments are rolling back subsidies in solar, because you don't need as much investment if you can still build the same thing for less money. Now, these reduced reduced subsidies had a big impact on solar deals because APAC is such a big player in this industry. Such a fast-growing region, so it makes sense that over 3/4 of the growth in global power demand in the past 5 years has come from APAC. China and India, obviously, very fast-growing economies. To help reduce emissions, APAC's been building solar plants, and in fact, it's been leading the world in solar and wind installations. The private investments played a very key role in enabling this. In fact, private capital is the largest source of capital for renewables in China. So if less investment isn't really a worry, so long as capacity is growing, is capacity in fact growing? Can I have the next slide, please, Will? So as you can see here, China's proportion is actually declining over time. So you can see the impact that less subsidies is having on the industry. And in fact, is capacity growing? The forecasts are saying no. COVID-19 is preventing new builds because of social distancing measures, financing challenges, those sorts of issues. That means in APAC, up to 150 gigawatts of solar and wind projects could be delayed or canceled entirely if today's recession carries on beyond 2020. And that's from the consultants Wood Mackenzie. Now, if you're asking, how much is a gigawatt? What does that actually mean? Well, it's enough electricity to power 110 million LED bulbs. Or if you're a fan of the movie Back to the Future, it's enough power to send 123 DeLoreans back in time. It's kind of a lot. So delayed projects because of COVID could push back the renewables construction pipeline by nearly 2 years, which would further reduce deal flow. However, looking ahead, the outlook for solar investment is positive, with more opportunity in India versus China. Why is that? Well, India set some ambitious renewables targets, 40% of power generation from renewables by 2030, and that's 40% up from 9% last year. India is also offering financial incentives for power generated by solar systems, and it's keen on investing in floating solar facilities following a pilot project. Can I have the next slide, please? I like to end this with a look at how solar could power the world's future. China already has the world's largest solar capacity at 130 gigawatts. And at home, you can see it's building mega farms. Some of them are shaped like panda bears, as you can see in this picture. Why is it doing that? Well, it's all an effort to promote interest in renewables among young people. In fact, the idea for this panda-shaped renewables farm came from a 15-year-old schoolgirl, so it's pretty cool. Chinese companies are now helping to build mega solar farms abroad, so it's not just domestic. So this is now having a geopolitical as well as a commercial dimension, because through initiatives like Egypt's 1.5 gigawatt Benban project, China's helping to power the developing world. And that's it for me. Thanks, Will.
Thank you, Nicole. Our last asset class presentation is from Jishan, who's going to take us through what's going on in private debt.
Thanks, Will. Now, the impact of COVID-19 on the level of fundraising activities for APAC private debt continued in Q2. So if you can look at the bar chart in front of you, only 3 vehicles held final closes in this quarter so far. And if you add the 3 to the 5 in Q1, year-to-date number of fund closes are only half the average seen in the last several years. But despite the disruption, the headline for private debt in APAC is that Q2 fundraising bounced back in terms of capital raised. In fact, if we compare second quarter performance in recent years, the $2 billion collected by regional fund managers is the highest since 2015. And this was achieved without June's figures. So this makes amount raised year to date more impressive, as it could have been higher had fundraising not been put on hold for some managers due to travel restrictions and other social distancing measures. So the signs are clear. There's a huge investor interest in this space waiting to be unleashed. But given the evolving situation with COVID, where are the opportunities in which strategy, which market? So if we can go to the next slide. In general, the opportunity set is really dependent on 1, time frame, 2, location, 3, nature of the investor themselves. So first, time frame. Because of lockdowns, all businesses have had to suffer revenue losses, some more than others. And the losses continue to accumulate even as we see a number of Asian countries slowly reopen their economies. Governments across the region have, to varying degrees, passed laws on debt moratoriums and also rolled out relief packages to encourage forbearance and kind of help everyone to stay afloat. So in the immediate to near term, most of the deal activities will be centered on refinancings and direct lending to cover working capital needs, though, as a lot of industry participants have mentioned recently, at a higher price point than pre-COVID. These transactions also tend to be quicker to arrange than, say, distressed opportunities. And with bigger spreads, because of increased liquidity demands, direct lending will be the deal type to look out for. However, if we fast forward 3 to 6 months' time, after we have kicked the can down the road, so to speak, losses will start to crystallize. And already we are seeing news on bankruptcies. Banks may start to rein in lending to select customers, so SMEs in particular will need to turn to non-bank lenders even more. Now that's when distressed opportunities will increase depending on the shape of the recovery, whether it's V, U, etc. Now second, the opportunity set differs country by country. China, where the outbreak started, is being held up as a roadmap on how recovery will look like post-COVID. And current indicators point to a slow recovery, as what Kai mentioned, demand and consumption remains muted even as factories restart production. On the other hand, countries such as Thailand and Singapore, whose economies are more outward-looking, could see a longer recovery process. If we zoom in to China, the non-performing loans market could be an area to keep an eye on. Amid the outbreak, the Chinese banking regulator announced in March that it will establish a 5th national asset management company, AMC. So why is this important? Just a brief background, China's NPL space can be divided into primary and secondary markets. The primary market is exclusive to 4 domestic national AMCs, which are mandated by the government to acquire NPL portfolios directly from China's big 4 state-owned banks. Foreign investors are only allowed to buy NPLs from the AMCs in the secondary market via a competitive bidding process. Given the sheer volume of the market size in China, the US wants greater access to these NPL opportunities than the current second-hand transactions. So much so that it was negotiated into the Phase 1 trade deal where China agreed to allow US firms to acquire NPLs directly from Chinese banks in the primary market. But the keyword here is eventually. So pending that, the announcement in March for 5th National AMC was a positive signal by Chinese policymakers to increase the deal flow of NPL into the market. And according to industry players like Shawvest, the spillover of NPL opportunities from COVID will emerge in 2021 or 2022. Again, linking back to the time frame factor we talked about earlier. Now, finally, the opportunity set varies with the nature of investors. If you are a new manager or LP to APAC private debt, you might want to invest in developed markets like Singapore, Hong Kong, Australia, as these have jurisdictions that are similar to the US and EMEA. On the other hand, if you're experienced in the space, have deep market expertise to navigate through the different jurisdictions, and of course the stomach for more risks, then you can boost returns in China, India, or Southeast Asia. But in light of the added risk and uncertainty due to COVID, and you couple that with a fragmented space and a developing asset class in APAC private debt, it's likely that asset owners will favor managers with a demonstrated track record to tide them through and capitalize on opportunities at the same time. So in summary, there's a huge demand for APAC private debt, but wherein lies the opportunities will really depend on time frame, location, and the nature of investors themselves.
Thank you very much, Shishan. That was, and thank you to all of our speakers. I think those were some really interesting points you all made. We now come on to the Q&A section of the webinar, which Mark is very kindly going to moderate. We've already had lots of questions come in, so thank you to everyone who's already submitted a question. You can, please do keep on submitting them, and we'll get through as many as we can in the time remaining. So without further ado, I will end this screen share so you can see all of our speakers' faces, and I will hand it over to Mark.
Tremendous. Well, thank you, Will. And Will, can I echo your thanks to the speakers? What a great job you all did. That was incredibly professional, incredibly informative. Aoife, I'm just really interested in your rapid tour around APAC. Yes, it's not a region, it's many different regions, but really amazing the pace and proficiency with which APAC is recovering from COVID. And as you've all said, maybe the experience with SARS and MERS, helps with that, but and maybe that's kind of encouraging for Europe and North America and the rest of the world as we look ahead, as next time we'll be better prepared. We've got about 20 minutes, is it, Will, to go through some questions?
About 15, yeah.
About 15, okay. Well, we'll be really quick. Look, you've sent in some questions. We'll deal with those first. And I see there's another half dozen come through while people have been speaking. But let's, go through in order, and let's get right on to you, Judith. Great presentation on private equity. Really impressive, the trend you've identified with deals in China really recovering already. What sort of trends are we seeing in India and other parts of APAC?
Yeah, thank you, Mark. Yeah, so in the same lights in terms of the deals trend, if we can see about other parts of India, India had a lockdown somewhere around late March. So we also see a dip in terms of deal volume and transactions when the lockdown was being announced. Similarly, we are seeing the same impact in Southeast Asia as well. Number of deals and transactions in Southeast Asia hasn't been as big a volume as compared to India and China. But that said, we still see a dip in the transactions each time the country actually announced some form of lockdown measures. And we do think that that is because, fund managers are uncertain whether that market would perform anymore, whether that sector would perform, and also all the due diligence and how it's going to play out. So I think one general trend we're seeing across all countries is that once some form of lockdown is announced, there will be a drop in transactions. And what we're seeing in China, once the lockdown is being lifted, it's being announced, the transaction volume actually slowly recover and increased. So hopefully we see the same in other regions as well.
Very good. And just, I was really interested, Judith, by your chart on fundraising and the actual growth in fundraising in March. Do you think that was real market growth, or was that fund managers who'd been on the road saying, oh my goodness, COVID is here, let's close the fund and get on with investing because they're big opportunities, but let's not, beat our heads against the brick wall trying to raise new money now?
I guess maybe about 80% of the funds that actually close on target or above target, those would probably have already planned in to close the fund in Q1. But given that our stats actually shows that, you know, about 30% of the funds actually closed less than what they expected to. So they kind of, you know, just stop fundraising altogether and just start putting the money to work.
Tremendous. Thanks for that, Judith. Kai, tremendous presentation and welcome to Preqin. It's great to have you with us. Really interesting presentation on real estate. Is COVID having any impact on tenant contracts in APAC, both, you know, kind of commercially and residential?
Yeah, so I think, you know, the basis of real estate, you know, maybe even especially for office real estate, you know, what makes it tick are long-term tenant contracts, right? You want to lock in a large, stable client for a really long time. You know, but what we're hearing is this might be changing. So, you know, a couple of RE legal advisors, they said as a result of COVID-19, there's been a growing need to build flexi plus fixed terms into contracts to account for a more mobile and fluid workforce. So what this has also done is GPs are also more interested in things like prop tech. So, you know, Internet of Things, to help asset owners, you know, plan the efficient use of space, as well as, you know, reduce overheads around things like, you know, energy usage. So a few examples were, actually some pretty cool examples were given, but, you know, basically technology is enabling, you know, more dynamic pricing and flexible planning capabilities for GPs to, you know, adapt to the new normal, whatever that might look like in the future. So I thought that was pretty cool.
Absolutely, really interesting points, Kai. And I guess the underlying point is, as you say, the new normal, whatever it is, amazing, tremendous change in the real estate industry, and as in major dislocations before, the private capital industry will prove itself very nimble, and there'll be huge opportunities there. So thanks for that, Kai. Diana, really interesting presentation on hedge funds. Big long pattern of outflows, but interestingly, a number of new launches in this year thus far. But given those outflows, what can you say about the appeal of hedge funds for investors at the current time?
Diana, you're on mute.
Oh, yeah, sorry. Yeah, I guess for that, Mark, since hedge funds, most appeal of the hedge funds globally is its uncorrelated returns and also generating alpha amidst of the downturns. I guess the appeal would be on those more niche strategies such as cryptocurrency, volatility, as well as macros and CTAs, since, you know, it has been proven that these specific strategies have done well in the downturn. And I think investors will look more into it as part of their hedging and as part of their insurance on their investments.
Very, very good. Well, thank you for that, Diana. I'm rattling through because we've got a number more questions coming in, so we'll get on to those. Nicole,
sure.
Thank you for that. I was really glad that you delved into, you know, one area within real assets, solar power, incredibly important. Tell us about some of the most promising opportunities that you think in solar looking forwards.
I think one of the most interesting ones is, I mentioned it briefly, that the Indian government is looking to offer incentives for floating solar parks. And this is where you build solar panels on a structure that can then be put in an industrial pool or a lake of drinking water. So it means that, you know, you don't have to use valuable land to build these mega farms. And that seems to be the direction as well. Okay,
and now in China, they're building panda-shaped solar parks. Are they building Buddha-shaped ones in India, or?
I think, you know, well, the world is their oyster now, because China got a huge amount of publicity for that stunt. And so, you know, the company that built it went everywhere. The financiers behind it went everywhere. So my advice to investors is try to think of maybe a Buddha plan would be a good one.
Yeah, excellent. Ji-Cheng, thank you so much for your presentation on private debt. Really interesting. Interesting to see it recovering strongly in Q2. What differentiates private credit in APAC versus the US and EMEA? Is it the same or is it different?
I think there are a few differentiations. I can quickly list three. So just now, during my presentation, I mentioned about the fragmented jurisdiction in APAC. So basically, you can divide the region into two sections: developed markets like Hong Kong, Singapore, where the jurisdictions are similar to the West. So deal structuring is relatively straightforward. But if you are talking about developing countries like China, India, Indonesia, there's a bunch of additional challenges regarding foreign ownership, capital controls, regulatory issues, etc. And that partly explains why there's also very few PD managers that are pure play here. So in APAC, we see mostly generalists. Fund managers have a wider focus that blends private debt strategies across the spectrum. And you probably have more specialists in the US and to a lesser extent in EMEA. So, but that said, having a broader mandate, it's not necessarily a bad thing, as some investors see that as a unique selling point. And given the evolving situation with COVID right now, a flexible and nimble approach could do well. So lastly, if we combine the 2 points I just made, essentially it translates to lesser competition here for assets than in the US and Europe, as you really need to know the market to operate and capture the market inefficiencies in this region.
Very, very interesting. Thank you for that. Listen, guys, you've done an amazing job, and our audience have done an amazing job. We've got 10 questions that have come in since you've been speaking. So I'm going to pass these around to you, and I want 10-second answers, okay? Because we're going to try and rattle through all of them. First one for you, Kai. Question is, with the drop of sterling, is there an increase of Asian investments in UK real estate assets?
Oh, that's interesting. Okay, so I think I would probably try to answer that a little anecdotally. So a couple of family offices I do from the past, I actually spoke about buying property in London, actually, where they invest quite heavily into real estate. Basically, the idea, what it sounds like is that at the same time that the pound dropped, right, you have Southeast Asian or emerging currencies also weakened quite substantially against the US dollar. So the net benefit between maybe Asian currencies as well as against the pound actually wasn't as great as you might think. And then if you look at more luxury prime property, that the change in asset valuations wasn't that high. Basically.
I'm going to stop you there because very interesting. We've got to rattle on. A question for you, Diana, on hedge funds. We've seen, sorry, I've just lost it here, 1 second. Hedge fund managers opening offices in China. Was that happening in Hong Kong or in mainland China?
This is actually happening in mainland China, and it's basically an effect of the Chinese government relaxing foreign investment restrictions on the country. Thus, the influx of foreign investors going in.
So that's a really quite a new development, hedge funds in mainland China. Interesting. Judith, a question on, sort of deals. As lockdown happens and as valuations are lower, do you think we're going to see a boom in deals? Are we going to see real rapid recovery?
Yeah, so I think there's two parts of it. For the deal activity, it will increase mainly because some of the sectors become more attractive right now. Say, for example, healthcare deals, as well as the consumer deals that are like food delivery, that is more attractive now than before. So I think there will be an increased deal, but it may not just be because of the set valuation drop. It could also be because the sector itself became more appealing to the fund managers.
Absolutely, a combination of valuation changes in the sector. Very, very interesting. A question on private credit for you, Ji-Ching. Which countries have the largest markets in APAC for private credit?
Well, as it stands, it's definitely the developed countries. So you're talking about Hong Kong, South Korea, Japan, but definitely China, it's one to look out for in the near future.
Very good, very good. And the next question is actually, I think, kind of for me, if I can find this. Given the developments in Hong Kong and UK announcing possible changes in visa laws, is Preqin expecting its operations in China to be affected? Simple answer is no. You know, one of the great things about having, you know, a base in, you know, close to the market is, you know, we can be insulated from that. So great question, but you know, our plans are intact. And another question for you, Ji-Chin, we're really lots of questions on private credit. Has there been an impact on the private debt market from central bank intervention, particularly with issuance increasing significantly to take advantage of lower spreads? What's
Yeah,
there?
definitely. I just saw a post recently from Mohammad El Arian, the ex-PIMCO CIO, and I think he sums this up very nicely. Basically, what the central banks is doing, it's direct and indirect market subsidization. So investors in the short term, they are stretching for returns, comforted by the strong comfort in central bank backstops. But companies that are facing unprecedented revenue hits are eager to avoid what they view predominantly as short-term liquidity problems, which will actually turn into longer-term solvency ones. So going back to the presentation, I think in the short term, central bank relief would definitely help companies stay afloat. But in the longer term, as companies, you know, get hit when it comes to revenue, we would see more opportunities for private debt managers.
Very good, very good. There's now a question again on private equity. So for you, Judith, very quickly, what significant differences do you see in the market trends between private equity and VC activities in China versus other parts of APAC?
I think as we speak right now, because China has moved out, was the first hit and has moved out of the lockdown and has the situation more or less controlled. So they're on the road to recovery versus other parts in APAC, maybe they're still trying to get the grasp of the situation. So they are still seeing a bit of whipsaw in terms of the deal transactions being done. So I think that is the key difference. But in general, deal transactions hasn't changed much. Everybody had an impact and a dip in the number of deals being transacted in each country.
Right. Excellent. Guys, you're doing such a brilliant job. We've only got a minute left. Kai, we've got 3 questions on real estate. I'm only going to ask you one. Apologies to the other 2. We just going to focus on this one. Really interesting question. Any news on what's happening with office developments adapting to distancing, requirements?
Yeah, I think both in residential and office, actually, there was a couple mentions even during our webinar that GPs are planning developments now to incorporate more space and distancing, besides, this open office concept, actually dividing up spaces more intelligently, which also kind of plays on this point with IoT, where they want to plan out the movement of people within offices. I think that's what they're paying most attention to now.
Tremendous. What a tremendous job you've done, guys. I think we're out of time. Can I just congratulate and thank all of our speakers? You've done a brilliant job. Also, our attendees, our 150 or so attendees, have done an amazing job. You sent in some really good questions. Thank you for that. I'm going to hand back to you now, William, to round it up.
Yes, thank you, Mark. Well, I mean, all that remains is for me to echo that same sentiment. Thank you to all of our speakers, and thank you to Mark for moderating that discussion for us. I don't know about you guys, but I've certainly learned a huge amount more about what's going on today. So I think this has been a really useful session. So yeah, all that really remains for me to say is thank you to everyone who came. I hope you have a good rest of the day, and I hope to see you all again soon for another session along these lines. Thank you.
Thanks, everybody. Take care.
Bye.
Thank you.